Most real estate syndications fail to raise capital not because the deals are bad, but because they're structured for lawyers, not investors. After raising multiple nine figures in private capital, here's what I've seen. Compliance doesn't close checks, confidence does. Now, obviously, you need to be compliant, follow the rules, listen to your lawyers, but ultimately, it's your business, it's your vision. Make sure you do it right, but don't let the lawyers run your business for you. So, after 20 years, I've realized that there's really three structural levers that make a syndication irresistible. And when you dial these in, the capital shows up fast. So let me show you exactly how to structure your next deal so investors can't wait to work with you. Point number one, structure for clarity, not complexity. Most operators think a sophisticated structure will impress investors, but I can tell you firsthand, complexity kills confidence. Your structure should highlight your unfair advantage and not bury it in legal jargon. If you can't explain your deal in 60 seconds, your investors definitely won't be able to explain it to their spouse. And if they can't explain it, they won't write a check. I'll give you an example. When I bought workforce housing in Tennessee back in 2020, this became obvious fast. See, workforce housing is misunderstood by a lot of people. They confuse it with Section 8, they confuse it with low-income housing, and the stigmas that come with those labels kill deals before they ever start. For context, we bought about 300 workforce housing units, and we kept the structure and story super simple. We started with the affordability gap, why so many Americans can't afford to buy. Then we broke down the types of renters that exist. There's high-end renters who literally choose to rent as a lifestyle choice. There's up-and-coming renters who are trying to put money away to become homeowners. And then there's the backbone of the entire rental ecosystem, workforce renters. And these are likely going to be lifetime renters because of the type of work they do and just the limitations on their skills or capacity or whatever it is. And look, these people are not looking for handouts. They are hardworking, good, honest people. But unfortunately, the skills that they have and what the market pays them keeps them at a certain threshold. And look, once investors understood that, everything clicked. The logic would kick in and they could understand that we were buying these assets at a fraction of replacement cost. So in other words, we couldn't build what we paid for it. And when you add that with the local incentives that were in place, like for example, there was a pilot program in Tennessee which essentially allowed you to freeze property taxes at the pre-assessment level while you added value, which created the incentive for someone like us to spend millions of dollars to increase the value of the property because we would be able to enjoy the lower tax rates for a period of time. So when you combine the big renter base with the fact that we could buy these assets for less than what it costs to build, and we could provide clean, safe, and affordable housing, plus the municipality would incentivize us to actually make that happen in certain neighborhoods, all of a sudden the entire pitch became compelling because the structure was simple. And I can tell you, clarity raises capital. Complexity repels it. Point number two, you need to structure your investor pipeline into the deal. Pros don't build syndications as one-off deals. They build them as part of a long-term investor pipeline. Most operators raise for deal one, then they restart and they raise for deal two, then they stop and they raise for deal three. I can tell you firsthand, when we closed our first 82 unit acquisition in that Tennessee portfolio, I built the pipeline into the structure from day one. And yes, we did webinars and quarterly reports, but the thing that created the real loyalty was the on-the-ground transparency in between transactions. See, I would do simple things like every time I flew into town, I'd pull out my phone, walk the property, and record raw updates. Drywall going in, cabinets being replaced, cost-saving workarounds, a quick chat with a contractor on video just to let clients see what's actually happening boots on the ground. And sometimes I'd even send the clips raw. Other times I'd have someone on the team stitch together a simple 5 to 10 minute progress report. And you know what? Investors love those more than the newsletters because they felt like they were seeing the real process, not just like some curated, overproduced version of it. And that kind of communication actually builds trust long term before the next deal is even around the corner because it becomes a structural way of how you communicate with your audience. And it creates referrals. And by the time you present your next opportunity, people already feel like they're connected to how you operate and why you do what you do. Point number three is structuring the conversation process into your terms. See, most operators hope investors just get it. Professionals, they engineer the clarity so investors can't help but get it. Your preferred return, the splits, the exit plan, all of this should be simple enough for somebody to explain it in under a minute. In my mind, that's the conversion metric. And clarity drives urgency. One of the most honest ways to create urgency in your deals is just to anchor everything in math. No pressure, no gimmicks, just reality. So as an example, if you're raising $4 million and you already have $2.5 million committed, that leaves $1.5 million. And if your average investor historically has committed $150K, you potentially have room for another 8 to 10 investors max. So when someone says, I need to think about it, you can respond with, hey, totally get it. The only challenge that I have is that we're raising $4 million. We've already got $2.5 million committed, which leaves $1.5 million. Now, in our last deal, our investors averaged about $150K per investor. So realistically, we're only looking for another 8 to 10 people. for a little more context, I've got several events and presentations coming up where I'm going to be sharing this opportunity. And based on that, I expect the remaining spots to fill quite quickly. So if this is a priority for you, great. If not, all good. We can revisit it on a future deal. It's factual, it's calm, it's transparent, and investors appreciate that. It also shows you run a professional process. And guys, obviously, always make sure you have your disclosures and compliance pieces in place. Work with your lawyers, make sure you're compliant with all the rules of raising capital. When you do structure your syndications or your funds this way, raising capital stops feeling like a reactive activity and starts feeling more systematic. And that's the shift. Real operators don't rely on hype or personality. They literally rely on clarity, consistency, and a process that makes investors feel secure from the very first conversation to the final wire. Now, if you guys want to go deeper on how all of this works, the next video on the screen will actually break down the full framework step by step so you can strengthen the way you raise capital for your next deal.